Okay, let's dive into this. SpaceX. You know the name, right? It's honestly more than just a company at this point. It's practically a cultural phenomenon. Between the reusable rockets landing themselves, the Starlink satellite dishes popping up everywhere, and the whole push to reach Mars, it's totally embedded in our collective consciousness. But listen, today's explainer isn't about their crazy engineering feats. Welcome to the explainer. Today we are unpacking a financial event that is shaping up to be entirely unprecedented. Our source material gives us this brilliant deep dive analysis into the upcoming SpaceX IPO, and we're going to break down exactly what is happening beneath the surface of this massive market move.
Our source kicks things off with a figure that is just truly staggering. Elon Musk is reportedly preparing the largest initial public offering in human history, aiming for a target valuation of $1.75 trillion. Yeah, trillion with a T. That number is so astronomically large, it honestly kind of loses its meaning when you just say it out loud. It's incredibly hard for our brains to conceptualize a trillion of anything. So let's actually put that massive valuation into some real-world context.
According to the analysis we're exploring, a $1.75 trillion valuation means SpaceX would be worth more than every single American defense contractor combined. Just let that sink in for a second. All of them. Or, if you want to look at it through the lens of everyday consumer brands that basically run the global economy, SpaceX would be worth more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks. Literally all put together.
But right after establishing that mind-bending valuation, the source drops an absolute bombshell about the company's profitability. Last year, the consolidated company of SpaceX actually lost $5 billion. Yes, you heard that right. I know, it sounds crazy. Despite bringing in roughly $18.5 billion in top-line revenue, the combined entity still operated at a staggering $5 billion net loss. I mean, that is a vast chasm between the money coming in the door and the money required to actually keep the lights on.
Which immediately frames the central mystery of our explainer today. Who exactly steps up to buy a company that is bleeding $5 billion a year, but is somehow priced at a record-breaking nearly $2 trillion valuation? To answer that, we really have to look past the cultural hype and examine what SpaceX actually is under the hood. Because, as the source points out, the public perception doesn't quite match the corporate reality.
Section 1. Deconstructing SpaceX. 3 stacked businesses. If you ask most folks on the street what SpaceX does, they'll immediately say, oh, they build rockets, or they're going to Mars. But the source explains the corporate structure is way more complex. SpaceX is essentially 3 completely distinct businesses stacked on top of each other.
And this brilliantly illustrates the projected 2025 revenue breakdown. Take a look. Starlink completely dominates the financial landscape here at 61% of revenue. The famous rocket business, the one that grabs literally all the headlines, only accounts for about 25%. And finally, making up that remaining 14%, we have xAI and other ventures. Now, we need to look very closely at that third segment because the source identifies it as a highly problematic piece of the puzzle. A few months ago, SpaceX acquired Elon Musk's AI lab xAI in an all-stock deal that valued xAI at $250 billion. The source impartially compares this to the competition to show just how steep that price tag really is. Notice the huge discrepancy here. OpenAI generates an estimated $4 billion in revenue with an $850 billion valuation. Anthropic generates over $30 billion with a $400 billion valuation. But xAI, with only an estimated $1 billion in revenue, it was valued at a massive $250 billion. The multiples are just staggeringly different. And the internal state of xAI makes that valuation even tougher to swallow. As detailed in the source, the company was founded with 11 elite co-founders from places like DeepMind and Google. Yet by March of this year, 0 of those original co-founders remained. It's a pretty stark fact. The company is burning through more than $1 billion a month, and the CEO admitted it basically had to be rebuilt from scratch. The source essentially argues that xAI acts as the cash-burning reverse Jerome Powell of the operation, just rapidly draining the profits generated by the other divisions.
Then, of course, we have the rocket business. This is the part of SpaceX everyone knows and loves. It launches government satellites, handles NASA cargo, completely dominates the news cycle. But financially, it generated roughly $4 billion in revenue last year. Look, launching rockets is arguably one of the most capital-intensive industries on the entire planet. Building the hardware, maintaining launch pads, funding deep research, it consumes cash at a blistering rate. The source points out that while $4 billion is a solid number in a vacuum, it is completely unimpressive when weighed against a total valuation of nearly $2 trillion. But the story changes entirely when we get to the third business. Our source highlights Starlink as the absolute crown jewel of the company.
It is an incredibly efficient, cash-printing telecom giant. It's got 10 million active subscribers across 150 countries. It's projected to bring in $11.4 billion in 2025 revenue. And most impressively, its profit margins have expanded from 41% to 63% in just 2 years. In the telecom world, margin expansion like that in just 2 years is almost unheard of. Starlink is absolutely what pays the bills.
Section 2. Nasdaq's red carpet, changing the rules. So let's recap. We have a highly profitable telecom business, a decent but extremely capital-heavy rocket business, and a massive cash-burning AI lab. But why is this specific combination going public right now? Well, this brings us to a massive shift in structural market mechanics. The source claims that Nasdaq quietly changed their rules right before this IPO.
Let's see how this builds the case for what the source calls manufactured demand. Under the old Nasdaq rules, a newly listed company had to wait 3 whole months before being added to the Nasdaq 100 index. Historically, 3 months of pure price discovery is crucial, right? It gives the open market time to establish a fair, rational price for a new stock based on actual trading, which protects everyday investors from early volatility. But on May 1st, Nasdaq adopted the fast entry rule, compressing that safe waiting period down to just 15 trading days. Furthermore, there used to be a strict minimum free float requirement. A company needed to make at least 10% of its shares publicly available to join the index. The new rules eliminate this minimum entirely. And this is highly relevant because according to our source, SpaceX is targeting a free float of only 4 to 5%. Under the old rules, they wouldn't even qualify for the index. Today, thanks to this perfectly timed rule change, they absolutely do.
But the most technical, and perhaps the most impactful change of all, is what the source refers to as the hidden multiplier. It's this subtle tweak, buried super deep in the dense technical language of the new index rules, and it frankly changes everything about how this stock will be purchased.
The rule clarifies that for companies with a free float under 20%, the Nasdaq now legally treats that float as if it were 3 times larger than it actually is. Let's walk through the math on that, step by step. SpaceX's targeted 5% float is suddenly treated by index funds as a 15% float. The source explains that this mathematical multiplier artificially manufactures massive forced demand from passive funds. Those funds are strictly required by their own mandates to track the index. They literally have to buy as if the float is 3 times bigger.
Section 3. The investor trap, passive investing costs. Now, what's really interesting about this slide is how it all connects back to you. You might be thinking, okay, that's high-level Wall Street mechanics. How does this involve me? Well, it involves everyday retail investors intimately.
Most initial public offerings allocate anywhere from 5% to 10% of their shares to retail investors. However, our source presents data showing that SpaceX intends to dump an unprecedented 30% of its IPO supply directly onto everyday retail buyers. In the context of a $1.75 trillion offering, allocating nearly a third of the supply to retail is a staggering anomaly.
When explaining this unusually high allocation, Brett Johnson, the CFO of SpaceX, stated, "Retail buyers have been incredibly supportive of us and of Elon for a long time, and we want to make sure that we recognize that." Sounds great, right? A generous reward for years of brand loyalty. But our source offers a much more cynical interpretation of these underlying mechanics. The source highlights a pretty stark warning from portfolio manager George Noble, who famously said, "Your 401k is the exit liquidity." Wow. The argument here is that insiders are using this unique combination of intense retail loyalty and fast-tracked passive index funds to basically cash out their own shares at peak valuation. The retail buyers are forced in early and the insiders unlock later.
So the crucial point is this. The very mechanics that make retirement accounts so easy are being leveraged here. Passive investing was sold to the public as the smart, safe, set-it-and-forget-it way to build wealth. But here's the catch. The system automatically buys whatever is added to the index. If Nasdaq changes the rules to let a company in after 15 days, removes the minimum float requirement, and mathematically multiplies that float, your 401k automatically becomes a buyer of that unprofitable corporate mashup entirely without your input.
Which leaves us with the ultimate question posed by our source material today. Is the convenience of passive investing forcing you to buy what you didn't choose? It's a fascinating look at the hidden architecture of modern financial markets, isn't it? And the true cost of set-it-and-forget-it investing. Thank you so much for joining me for this explainer. I really hope this provided you with a clear, structured understanding of the mechanics behind the upcoming SpaceX IPO. Keep learning, keep questioning, and I'll see you next time.